Welcome, everybody, to the Planet MicroCap Showcase Virtual. I'm your host, Robert Kraft, on behalf of SNN Network, and I'm so excited for your first keynote of the day. It's with Conor Haley from Alta Capital, good friend. We've known each other arguably a long time now, right? I think a long time.
I think so.
I think we're pushing double digits at this point. We're getting there, but but I'm so excited to have him here to catch up, get his thoughts on what's going on, and I mean, really just also talk about his growth as an investor. I mean, like I said, we've known each other a long time. I've known him since he was an individual investor. Now he's running his own fund and activist campaigns and joining boards. I mean, Conor, give us your 2 cents. I mean, what a year it's been. I think because the last keynote we had was August 2020. So, I mean, what a year it's been, huh?
It's been an incredible series of events in the world and the market, right? Tough time for the world. Surprisingly resilient market with obviously a lot of government intervention and mayhem in between. Fortunately for our firm, it's been a strong period of growth. We've been able to take advantage of, what were turned out to be some exceptional prices near the lows and in good businesses that were growing that in many cases, benefited from secular trends that were accelerated due to sort of COVID in terms of, more digital penetration, physical sales going online, or also just resilient consumer staples businesses, largely unaffected by COVID at historically cheap multiples. But yeah, fast forward a year and markets are close to all-time highs. There's a lot of fiscal stimulus still and talks about infrastructure spending and, people are still getting stimulus checks and things like that. So it's still, I think, an extraordinary period in the markets with a lot of questions that investors have to wrestle with and figure out. But even at all-time highs, I think that there are still pockets of opportunity, in certain industries and places in the world. And, it's our job to sort of go out and try to find them.
Where have you been seeing them mostly? I mean, you mentioned secular trends. I mean, what are some of the secular trends that have been most interesting to you when you've gone out searching and looking for new ideas or exploring old ones?
Our search for value takes us all over the globe. And I would say increasingly, we have been spending more time internationally, particularly just given how strong U.S. markets have been, how strong U.S. small cap markets, even year to date, have been, which is a notable shift from recent years, right? Where in general, the story of the last several years has been, the larger the market cap, the better the performance, and small and micro cap investors sort of loathe that reality. This year, small caps have actually to date outperformed, but there's been a lot of volatility recently. And, but yeah, if I had to summarize or provide a general statement, I'd say we're looking more internationally than we have in a long time. That's not, a top-down approach of ours. It's more of a reflection of the bottom-up opportunities that we're finding. We're just finding more internationally than we have before. And, our international watch list is more interesting than it's been before. So we're looking in, Western Europe, we're looking in Australia, we're looking in Canada, we're looking everywhere, mostly developed markets for good businesses that are maybe under the radar.
Absolutely. And, for those who may have been reluctant to looking abroad, maybe they see some of the same opportunities as you do, or, as some other well-known investors that we know, help allay some of their fears that it's not as scary or it's not as different. I mean, don't get me wrong. I know it's hard. We're not saying, looking at this stuff is easy, but, help them, give them some confidence that like, hey, no, you do a little bit of the work. It's not that hard to kind of follow these things and see what's going on international.
Yeah. Look, I think the international research process is always a little bit different. It depends on the geography. It depends on the management team. It depends on the language. It depends on a whole host of factors. But, in pretty much all cases, our own internal research process for an international name takes longer than a domestic name, just because, we have tremendous amount of experience researching domestic names. We've got a pretty well-oiled sort of process, right? Refined process to go through. Internationally, like it takes longer to set up management calls. It's harder to go visit them. There's just a lot of the disclosures may not be as good. Like there's just a whole host of things that make researching international names take longer. That being said, at a certain level of valuation disparity, that work is worth the incremental effort. And we have found that recently, and we're certainly, researching. We're certainly kept busy by researching a lot of international names right now, which seem compelling on a sort of risk reward basis.
Absolutely. Well, you know what? I think everybody's had enough of our overview of everything. I'm sure everyone listening right now is like, okay, yeah, great questions, Bob. I appreciate it. Can you ask him about collectors and then labs and Mama Mancini's already? And I'm going to get there. So, as I said at the open, you've gone from individual investor to starting your own fund, and now you're a couple activist campaigns, joining board of directors. So love to hear just kind of your motivation for, taking on these activist campaigns, as well as joining a board and really focusing on governance. So, love to hear it.
Sure. Any name that we research, any company that we research, we try to really think about it from an owner's perspective, a private owner's perspective, right? We try to put our CEO cap on, right? And think about, okay, if we were running the business, how would we think about capital allocation? How would we think about competitive strategy? Where would we be allocating capital? Where would we be pulling back capital? All these different things. And then we also want to put our CEO hat on for all the competitors, right? So we end up developing this industry view of where is this industry going? Who are the winners and losers? And what should individual players be doing in order to, be the winner in that industry and create a lot of value? And ultimately, we're investing in a small select group of names that we feel like has the opportunity set and the ability to execute on that opportunity set to create significant value for shareholders. And, normally we partner with, management teams that are very well aligned, that have the right incentives, that treat shareholders like the part owners of the business that they are, and are sort of trying to maximize value. And that's the most fun for us, right? Because everybody can win, whether it be shareholders, management, the board, customers, employees, suppliers. Like value creation, the capitalist sort of engine is really powerful, and it's not a zero-sum game. And so that's how we like to create value, and that's how we like to invest. However, occasionally you come upon situations where, there is an extraordinary opportunity set, but the management or the board or both are not executing on that opportunity set, or perhaps they're only partially executing and they don't have the right incentives in place. There's a whole host of factors that can play into it. But, look, we've gotten involved a couple of times in a more active way, right? So two of those have been activism. So the first was Collectors Universe. The second was In Labs, right? In Labs was very different than Collectors. In Labs, there was a very incentivized chairman who owned a lot of stock, who we had tremendous respect for and had created a lot of value for individual shareholders. However, the company and the board agreed to a buyout at a low single-digit premium to where the company was trading pre-offer price, and this was for a highly strategic asset, right, with tremendous growth potential. They had just made a really fantastic acquisition that really wasn't showing up yet in the numbers. They weren't getting the benefit of it yet. So this was an opportunistic bid by a strategic acquirer that was going to be using cash and or low cost debt that could afford to pay a lot more and needed to pay more because the 3% premium was not a fair compensation for the growth prospects for in-lab shareholders. And so, in that area of the world, in Sweden, you need 90% shareholder approval in order to effectively squeeze out the minority holders. And we basically banded with a few other funds and publicly stated our intentions as collective 10% plus owners of the business that we would not be voting in favor of the deal at the original offer price, and also stated the level at which we would, and which was a significant premium to where they offered. And we felt like represented, frankly, still a very good offer for the buying group, but at least compensated and showed some premium to where the company was trading today, in line with takeover premiums globally. And it became pretty clear that other shareholders felt similarly. We received probably over 100 emails, I would estimate, from shareholders talking about, thanks for sticking up for us. We're so disgusted with this offer and everything else. And it became very clear, I think, to the acquiring entity as well as the target that the original offer had almost zero chance of going through at any significant level beyond the board and insiders, which really wouldn't accomplish their goal. And so they ended up, increasing the offer very close to where we had suggested, and we agreed to vote in favor of the deal as a result, and shareholders came out far ahead. And so, I think that's an important example, because the reality is market trends have really been changing to the detriment of the individual investor. And this is particularly true in small caps, right? You've had this shift from active to passive investing. So now you've got a lot of passive holders that, don't think for themselves in many cases on a practical level. Like they'll either follow the recommendations of an ISS, for how to vote, or they'll follow the board in like a tender situation where ISS doesn't even, give a vote. And then you've got the growth of quant, which is kind of in the same boat. And so, it creates these situations and unfortunate opportunities where a small group of people, it can be an inquiring group, it can be a board, sort of band together, and they try to say, hey, how can we make money here, right, for ourselves? And often that is at the detriment of existing shareholders who have supported the company in many cases for years. And so this really isn't how the system is supposed to work. And, when individual shareholders are taken advantage of, I think that's sort of a loss for the capital markets. And, Sweden, for example, has much stronger rules in place than the US. Sweden, you needed 90%. Go back to the collector's example, you only needed 50% plus one. So you only need a majority of shares, right, to approve, which you might say, well, Conor, like that's completely fair. A majority wants it. What's unfair about that? Seems very democratic. But then you peel it back a little bit, and it's not really the case. So take collectors, for example. In the collector's case, management owned negligible amounts of stock. The board, despite an average tenure of close to a decade, owned negligible amount of stock and had been net sellers continuously for years. The capital allocation plan made no sense. They were sitting on extremely attractive reinvestment opportunities for years, and they were paying dividends out. And everything about it was obvious to any active investor who spent any time researching this name that there was tremendous potential that was not being executed on by the management team and the board, and it needed a shakeup. And that's the reason why the stock went up over 20%, I believe, in the first day or two of when we announced our activism. Right? When that happens, that's not a sign of confidence in the management team. That's a sign of excitement that someone else is coming in who actually has the best interest of shareholders at heart. And so, look, we weren't looking for a fight at Collectors Universe. That's not our MO. We came to the management team with a plan to create tremendous shareholder value that was well researched, that cost my firm tremendous amount of money, right, to put together. It's the type of research that they would pay consultants hundreds of thousands of dollars to put together. And we brought it for free as incentivized holders, looking to create value alongside a management team and board. And, there wasn't much interest or initiative because they didn't really want to take any risk, right? Why? Why would they? Like, they don't really benefit. They get a nice salary, right? And they don't have much stock. And so why rock the boat, right? And that applies at both a management and a board level. So, That was pretty disappointing. And, as shareholders of eventually, close to 5.5% of the business, which represented more than the entire board of directors combined, right? We were disappointed in this. And so we escalated this, this capital allocation decision. We basically wanted them to reinvest in these high margin recurring revenue SaaS initiatives, which we felt could more than, triple the value of the company in short order, and even more so in the longer term. And, the reality is they should have been doing it 5 years ago. And, when we were told that it wasn't really a near-term priority, there was no timetable, we decided we needed to escalate that to the board of directors. And so, we spoke to the chairman, a guy by the name of Bruce Stevens, along with the CEO, and we had a conversation, and we were hoping to chat about the presentation, which was all very amicable, right? It was, here's where we think you should be allocating capital. Here's the type of upside we see. We wanted to have a conversation about the industry and the business as material equity holders, one of the largest holders in the business. And, unfortunately, the response we got from the chairman was to basically, go pound sand, right? He had no interest in talking to us. He, basically said, we don't need shareholders telling us how to run our business. Right. And, look, you got to contextualize the situation here. We were large shareholders. We owned more than the entire board combined, which we had purchased with our own money. Right. The board had been granted stock for a decade and kept continuously selling it. So we were much more aligned with shareholders than he was. We spent a lot of money of our own researching these capital allocation decisions. We put a very thoughtful piece together. We approached the board. We approached the management. Not in a combative way, but hey, let's have a conversation about capital allocation and how, the company can drive a lot of value. Being very open-minded, and he wasn't even willing to talk about the presentation at all, right? And so that was really disappointing. And so as a shareholder, we had to sit back and say, okay, well, look, we've tried to work with them, we've tried to be amicable, but it's not working. They're not open to change. And when you looked at the incentives, it was clear why. And so at that point, we had to decide whether we wanted to push further. And ultimately, it wasn't an emotional decision. It was a practical one. What is the right risk reward for my own LPs, for which I have a fiduciary duty? And we ultimately decided the risk reward was so attractive that we needed to push back and exercise our rights as shareholders. So at that point, I made it, a max position size in my main fund, which for me is basically 15% at cost. I then raised a separate, a special purpose vehicle, a separate fund to invest alongside my main fund at a very difficult time to raise capital. April of 2020, right? Just coming out of March. It's a very difficult time to raise capital, but I told investors, this is the best idea I've seen in many years. And, I'm willing to make essentially a career bet on this. And, we bought 5.5% of the company, roughly. We issued a letter to shareholders. We came out with an alternative proxy slate, or an alternative board of directors via, threatening a proxy vote. And, the stock was up. The market loved it, right? And I think there were a lot of other holders who knew the potential and realized, these guys are sitting on so much value. And finally, someone has come along to push them in the right direction. A lot of things transpired after that. Unfortunately, one of the board members on my slate ended up leaving the slate and try to take the company private. It was unfortunate. He had signed an NDA when I had sent him the original materials. He then informed me shortly thereafter that he had violated the NDA by, buying shares, having friends buying shares, and asked basically for leniency to get out of the NDA. At that point, I thought we were still working together, gave him the benefit of the doubt, signed it. And then the reality is he took advantage of that to get out of the NDA and then go form a buying group. And so he started conversations. This is all public from the proxy, from the background of the merger, to buy the company. They started talking when the stock was in the 50s, I believe. Kept going up. And then, we eventually settled with the company. We settled with the company because they agreed to do a lot of initiatives that we thought would bring a lot of significant value. So one, they appointed one of the board members that from our slate to the board. In addition, the board member, our appointee, was supposed to be leading a newly formed strategy committee to examine, digital innovations and things like that, basically examining the right capital allocation policy and how to utilize technology to improve the customer experience and improve, ultimately shareholder value as well. And, unfortunately, the company didn't really negotiate in good faith, right? They agreed to this, which also included a non-disparagement provision at the same time that they knew that they were very close to, this is my hypothesis, it can't be proven, but I think they were very close to agreeing to be sold to this other private buying group, led by, Steve Cohen and D1 and a whole host of other buyers. And so, the buying group ended up coming out with an offer at, I believe it was $75.25 a share, which again represented a low single-digit premium to where the company was trading pre-offer price. And even their language in the press release about the premium, they tried to use it relative to the last full trading day, quote unquote, ignoring a half trading day due to a market holiday. Like they were just using deceptive language to try and make this seem like this really great deal, when in reality it was an extremely small premium right before the company was experiencing significant growth. Shockingly, in some ways shocking, in other ways not, the board of directors voted in approval of this deal. So it had board support. And so now they needed 50% plus one vote. And they basically got zero outside shareholders to vote for it. It was less than 5% of the shares voted for it. Extremely embarrassing for the board of directors, frankly. They came out with press releases and reminding people. It was just embarrassing process. I think everyone on that board, frankly, should be embarrassed by what occurred. And it became very clear that they were not going to have the deal go through at $75.25. So the buying group then had to come out and they increased the bid to $92 per share. And, at that point, the board, again, voted to push forward the deal. And several large active shareholders, both at $75.25 and at $92, had come out against the deal. We had signed a non-disparagement agreement. It was sort of a legal gray area as to whether we could comment, given they basically ignored the deal we had made, or had made it in bad faith. But look, the deal ended up barely going through at 92. The company's chairman at the time came out and said, one of the reasons why you should take this deal is our prices in the back half of this year are going to be falling. Because we graded all the expensive cards first, essentially, in COVID. What we learned shortly after the deal closed, which frankly I think happened primarily because a lot of merger arbitrage hedge funds had come in, right, for the initial deal, thinking it wouldn't go through. They were correct. The deal pops, and then they tender into the deal. So a lot of active holders, again, that knew the business best, were not supporting the deal. But there's this low threshold of 50% plus one. The company hadn't been very forthright about the backlog, the pricing power, everything else. And so they were able to get it through with a struggle. Well, shortly after the deal closed, they basically announced they doubled the prices, on consumers. And, so the whole thing about our prices in the back half, I mean, it was a complete joke. Even if it was technically accurate, it didn't really represent the economic realities of the business. So look, it left, I think, a bad taste in a lot of people's mouth, because it represented, I think, what is worst about the markets and individual companies and boards that are not looking out for the best interest of the shareholders. I mean, just think about it this way. The board recommended shareholders take an offer of $75.25 just, a couple weeks before the final offer of 92, right? So were they either A, totally incompetent, that they negotiated the worst deal ever, right, for a low single-digit premium, right? Were they B, acting in sort of their own selfish interests and didn't really care since they didn't own much stock, or something else, right? I mean, it just doesn't make sense. They negotiated a terrible deal at $75.25. They negotiated a bad deal at 92. And, I think it's not something I think any of those people should be proud of. And if I was on another board that had one of those people, I'd have real questions. So, look, I think at the end of the day, I'm still very proud of what Alta Fox was able to accomplish. We initiated a position in this company in the, high teens, low 20s. We put out $100 price target, which was very ambitious at the time. We fought in our first activist campaign, we're able to rattle the tree quite a bit, leading to a lot of changes and I think a lot of pressure. And ultimately, I think that without our involvement, the company would have been stolen at a much lower price is my guess. And so, look, the price should have been a lot higher, but I think Alta Fox was instrumental in getting a better outcome than shareholders otherwise would have had. But ultimately, I think the governance also shows what is wrong with a lot of boards, particularly in the small cap space.
I was just going to say, I mean, by the way, thank you for all of that. I think everybody listening is like, that was incredible. Thank you for kind of laying out both stories. But I mean, what would you say are some of the biggest lessons that you learned? These are your first 2 activist campaigns. I mean, what was it over there? I mean, you did 2 in the last, what was this, year and change? What were some of the lessons you learned there?
There's a lot. So, the first is, look, I'm from Texas. I like to be friendly with people. I like to do business a certain way. I think integrity really matters. I like to give people the benefit of the doubt. I think, unfortunately, there's a lot of people who, will stab you in the back to make an extra dollar, right? Could be a board. It could be someone on your board slate. It could be anybody. And, particularly when you're dealing already with companies that, are requiring activism, right? There's a certain level of skepticism that you need to have, maybe beyond what I even appreciated at the time. I thought if you were negotiating a very reasonable settlement and hoping for certain things that there'd be some level of respect there. And it really turned out not to be the case. And so, that would be one, is to just be more skeptical of everyone, which is unfortunate. But I think that's a reality. And I won't make that mistake again, for sure. I think another thing I hope people really take out of it is, activism is often this like poisonous word used in the media, right? Oh, these hedge fund activists looking for a short-term profit, everything else. Look, like most things in life, it's not black and white, right? And that could not be further from the reality in the Collectors Universe case or the InLabs case. I mean, we were already shareholders in this company. We had spent a tremendous amount of time researching sort of the right strategies to lead to maximum shareholder value. Frankly, much more than the board or the management team, or at least much more thoughtfully. And, we were in it for the long haul. And really, we were the voice arguing for shareholders on shareholders' side, right? And, look, there were some other active funds that came out against the deal and were also, I think, very should be proud of their involvement by preventing an even greater heist of the company from a small group of wealthy shareholders trying to extract value at the expense of minority holders. So, look, I think activism can play a really important role by keeping, corrupt boards in check, by, trying to ensure that companies are run for the rightful owners of the business, the shareholders. And that's another takeaway. Any other lessons? Look, I don't love it. I don't enjoy it. I love working alongside incentivized, management teams and boards to create value. A great example is, I recently joined a board, Mama Mancini's.
Just gonna ask.
Look, it's run by, Carl Wolf. I think he's 77 now, going on 78, and the guy's a grinder. I've got a tremendous amount of respect for him, and he's done a great job with growth of the business. But like these. In the rest of the board, you've got, a lot of independent members really focused on shareholder value. And, that's refreshing, right? Because we're all working together, trying to have the best outcome for everybody involved. And that's really refreshing. And it's a nice contrast from, some unfortunate examples where, people are looking out for themselves.
Well, it's really important also because I mean, look, we're talking about small micro nano cap space. It seems like sometimes these boards and the governance it gets overlooked because they're like, hey, we're in the small micro nano. We don't have too many eyeballs on us. Like maybe we have some passive invest. Like we don't have to worry so much about it. But little do some of these companies realize if they have good governance, it only helps shareholder value. It only
Well,
helps it only helps.
it's a really good point because the irony of like the collectors universe situation, right, is we were urging the CEO and the board to buy back stock, right, when the stock was in the teens, right? They had a tremendous cash balance. They could have bought back stock at a double-digit free cash flow yield, right, and created a tremendous amount of value. The management and the board, we were encouraging to buy stock personally. They could have created a tremendous amount of value, right? Some of the people on my slate, right, who ended up going and doing their own thing, right? They could have 4x their money on a significant amount of capital, right? Just joining early, and frankly, more if it hadn't been cut off. And so, I think a lot of these decisions by management teams and boards, everything else, even if you're greedy and only looking out for yourself, which hopefully is not the attitude of, management teams or boards, but in some cases it is. Even if that's the case, I think you can often make more money by, trying to maximize your value in the public markets by doing the right thing. Because, look, there's a lot of opportunities for businesses to create value alongside shareholders, and management teams that do the right thing can create a lot of value through capital allocation and sort of sound policies.
I mean, look, I'm not trying to make a soundbite or anything, but it's like, why in situations like these, it's like, why focus on individual greed when you can have collective greed?
Yeah, it's sort of,
and that was not a pun at collective greed.
Look, it's kind of penny wise, pound foolish, right? To maximize short-term executive comp, right? Or something like that, instead of understanding how much value can be created over a number of years by taking the right actions. So look, it's unfortunate when you see it. It's blatant, it's often blatant and everybody knows what's going on. And, I think activists can play a very important role in keeping some of these boards and management teams in line.
Especially when you also have markets that are just continuing to go up and up and, sit this incredibly fast recovery, it's some of these boards, I would assume probably just like, hey man, we're not doing anything more. Market kicking ass and taking names. Like, why do we need to listen to you, Conor? You know what I mean? Like,
yeah, it's a good point also because it is true. Like one of the things that say the firms that help advise passive owners, right, for how to vote in an activist situation, right? One of the first things they look for, right, is, well, what's the trailing shareholder return, right, on a 3-year basis, a 5-year basis relative to comps. And look, of course, that's relevant, right? And it's a relevant piece of information, but it's only one data point, and it doesn't tell you, okay, well, what is the performance of that company relative to its potential, right? And so you take a company like Collectors, which, look, its performance had been okay, right? It wasn't amazing. It wasn't terrible either, but its opportunity set was amazing. It had this duopoly, market position in coins, this oligopoly position in cards, and they were sitting on these reinvestment opportunities and they were squandering it with cash. And, you look at the board and you look at who was running it, right? And it's, again, a guy who, Bruce Stevens, and, just look into his history, right? He had been the CEO of Steinway for a very long period of time. It underperformed the market significantly during his time period over like a almost 2-decade period. And so like there wasn't a history of respect for shareholders and value creation. And unfortunately, that sort of infectious attitude, plagued the Collectors board. One thing that stuck with me early on, which I later began to really dwell on as we were getting this really caustic reaction from management team and board when we were really just trying to help them and create value, was, when we pushed for the company to buy back stock, right, when it was in the teens and they refused. What I heard back from the CEO, Joe Orlando, was, well, that's a board decision, right? And he was on the board, by the way. It's a board decision, and my hands are kind of tied, right? Well, when I asked him, well, why don't you buy stock, right? Why do you not own many shares? Why don't you personally buy stock, right? The answer was basically, well, look, I would love it if the board gave me more stock, right? And so, like, what a terrible answer, right? Like, what a terrible answer. Your business is trading near the lows. It's got this huge opportunity. You don't own much equity stake in your company. You are paid a nice salary, which you can use to buy back stock to increase your ownership alongside minority shareholders and make a lot of money in the process, by the way. And your first reaction is, well, the board, in order for me to have more stock, the board has to grant it to me. That's just not the right attitude. And unfortunately, it is, it reflects a lot of the issues that plagued that company. And, it is what it is.
It is what it is. Well, here, let's turn a negative into a positive. For those who are listening to this that are active investors, looking not just at small micro nano caps, but just anything in general. What are some things that they can look for that you also look for when you're evaluating, not just the quality of the business, but now you're looking at some of the other qualitative stuff, management team, board of directors, governance, incentivization. What are some of the things that you look for now moving forward?
In sort of a good situation?
Yeah.
Yeah. Look, I think you want to see, a management team and a board that are aligned, right? They own stock. They have a capital allocation policy that makes sense, that's aligned with shareholders. The incentives for, for bonuses and everything else is aligned with shareholders and isn't egregious or out of line with sort of industry standards. I think you want to look at their history of value creation, right? Have they created value in the public markets? Have they created value beyond their competitors? Are they winning share, losing share? What is their plan for winning in what is often a competitive industry? And so I think there's a lot of qualitative factors. There's a lot of quantitative things you can overlay on those qualitative factors, but it's normally not that hard to figure out whether a management team is taking the right steps or whether they have their own agenda. And unfortunately, in collectors, it wasn't the case. Fortunately, in something like Mom Mancini is like, that's what attracted me to join the board. Is I felt like there were a lot of good people striving towards a common goal, and that's fun to be around, right? It's fun to be on a team, right, that's striving for the same thing and they're trying to do the right thing. Yeah. It's not that fun when there are a few players who are sort of saying, I want the ball, right, and I'm not going to pass it, and I just care how many points I score.
Oh yeah, you get free meatballs at every board of directors meeting. I mean, let's talk here.
Or maybe not. I don't know. One, but I hope that's part of it. Yes.
Well, before I let you go, how'd that go down? I mean, were you approached? Did you approach them? Like, how did that all happen?
Yeah, look, it's a really good. I believe it's a high quality company run by high quality people. We were excited about the sort of growth prospects, and we were a material holder in the company, right? So, at one point we owned over 5%, slightly less than that as of today. We're still long the shares, to be clear. And, I think in a bunch of interactions with the CEO, and he sort of appreciated the level of research and diligence that we had done, and thought that shareholder perspective potentially could be valuable on the board as sort of an independent director. And so that sort of led to a conversation and then another. And, I joined recently, and, it's a different kind of challenge, but it's an exciting one. And I think they have a good team, and I'm excited to see where it goes.
Very cool. All right. We'll leave it there. Conor. All right. Last question. Your forecast, not your forecast, but like, what are you seeing going on moving forward? I mean, anything that you're keeping an eye on that maybe others should too?
Yeah. We've had this period of extreme volatility, right? Starting with COVID, right? We had this big crash. We've had this, really impressive and ferocious rally. Volatility has been elevated. Recently, it's come down a little bit. I don't know. My crystal ball's as worthless as anybody else's, maybe even less useful. But it wouldn't surprise me if we had, a more consolidated market, right? Where you need to be tactical, right? Where long-term returns from these valuation levels in aggregate for the indices may not be as attractive as they have been. It's always hard to say, but that wouldn't surprise me given the valuation levels we're starting at, particularly in the US. I think where we could have, a bunch of assets go sideways for a while. Obviously everyone's watching inflation, right? Which can wreak havoc on a portfolio if you're not positioned correctly. And we haven't really seen for a while in any material way. So there's a lot of new forces in the market. And I think you've seen that this year versus last year, right? A lot of the winners last year have been losers this year and vice versa. We've seen value come back a little bit. We've seen small caps come back a little bit. Some of the laggards from previous years. And I think that's interesting. But look, there will always be opportunities somewhere in the world. And, I try not to pontificate too much or think about, where the markets are headed, because ultimately I'm trying to find that exceptional business with that management team that's just hungry to create value. And, it's our job to find them. And we don't need to find that many.
Very good. All right. Well, and by the way, for compliance purposes, just want to be clear that Collectors and N Labs, they were both acquired. So you clearly don't have shares anymore. So just wanted to make sure that we were clear on that. Right? Right? Correct. Okay, good. All right. So with that, Conor, where can our audience, you never know. People might be listening. They might not know. But Conor, with that, where can our audience go and find more information about you as well as follow you on social media?
Sure. So the easiest place is probably Twitter. So you can find me at Alta Fox Capital. You can also go to our website if you're interested. It's just www.altafoxcapital.com. You can sign up for our distribution list there, where we occasionally, post ideas and research and other things. So those are probably the two best places.
Very good. Conor, as always, man, thank you so much for doing this. Congratulations on, and hopefully everything goes smooth with your wife's pregnant right now. So, I mean,
we've got our own little spinoff coming very shortly.
Very sure. There you go. Well, wish you guys all the best. Please be safe. Let us know everything went well. And yeah, man, thanks again, dude. Really appreciate it.
Thank you. My pleasure.